After much fear and trepidation, the changes to private company taxation were much less punitive than expected in the latest federal budget. What Finance Minister Morneau had originally proposed to do back in July of 2017 was heavily watered down. I'm Peter Guay, and you're watching Do It Together Financial Planning. In this episode, we'll look at the impact of the 2018 federal budget on professional corporations and small businesses. If you're a professional with a corporation or a small business owner, the budget made two changes that affect you. One change might reduce your access to the small business tax rate, and the second involves a small change to the tax integration mechanism known as refundable dividend tax on hand. The second change is quite a bit more complex and has relatively smaller impact, so I'll leave it to another video. So how have the feds reduced access to the small business tax rate? Let's start with a little background. Until the 2018 federal budget, corporations paid 10% federal tax on the first $500,000 of active business income and 15% on the excess. Quebec charged 8% on the first $500,000 of business income and 11.7% on the excess. So the combined tax rates for Quebec-based corporations were therefore 18% and 26.7% respectively. Now, Quebec had already put measures in place to limit access to their small business tax rate. Essentially, you must have at least 3 full-time employees in your Quebec-based corporation in order to gain access to the Quebec small business tax rate. This effectively removed access to the low provincial rate for all incorporated professionals like doctors and lawyers. The feds, on the other hand, hadn't put any such measures in place, but have been increasingly concerned about the tax advantage that professionals were getting through their corporations. So here's what they did. For every dollar of investment income over $50,000 that a corporation earns, the small business income tax threshold will be reduced by $5. If you do the math, you lose access to the small business tax rate completely once your investment income reaches $150,000 in a given year. So once the investment portfolio inside the company is over about $1 million, you'll likely have more and more of the business income taxed at the higher rate. When you reach a portfolio of about $3 million, you'll likely lose access to the lower tax rate completely. Now, this change doesn't affect the tax rates you pay on the investment income earned in your corp. The rates on that income remain roughly equivalent to the top personal tax rates. This change only affects the tax rates on your active business income. So where does this change leave you? Each situation has different needs, but one thing to consider is reducing your investment income inside your corporation. To do that, you'll want to focus on holding investments that build capital gains over time instead of interest or dividend generating investments. Save those for your RRSP or your TFSA. Thankfully, this new tax regime protects retirees who hold their investments inside a corporation. Since their corporations are not likely to be receiving active business income anymore, their overall tax rates will remain unchanged. There is a bright side to all this. These changes will apply in 2019. So that gives us a little time to figure out how you're affected and what you can do with your business to prepare for the changes. It's going to be interesting, and I'll keep you up to date on them. But to get that information, you'll need to subscribe to my videos. So please, like my video, share, follow, and sign up to my YouTube channel so you get notified when I upload new ones. I'm Peter Guay, and this has been Do It Together Financial Planning. Thanks so much for watching.